last year. Chinese stocks go back in time. The Mekong Summit and this week's alphabet. This week's alphabet starts with H for Hubei province in northern China, the province that surrounds the big province-level municipalities of Beijing and Tianjin. The governor of Hubei, Mr. Guo Gengmao, told a Hong Kong newspaper that 30 companies from his province will IPO in Hong Kong this year. This bit of boosterism was lampooned by the Wall Street Journal, but it does reveal the process of corporatization as the Chinese state spins off its assets and retools the economy towards services and consumption. Next, a surprise H-share placement on Hong Kong late last week. 0552.HK, or China Communications Services, a company controlled by the China Telecom Group. The deal, worth almost 2 billion Hong Kong dollars or over 240 million US dollars, was backed by Cisco, IBM, and Blackstone, and the open portion was about 2.3 times oversubscribed. The company provides telecom equipment and services, and analysts believe the sudden share sale and its success is related to the long-awaited unveiling of China's 3G wireless standard, TD-SCDMA. China Mobile began today commercial trials of it in 8 cities that are sites of Olympic events this summer. 20,000 customers are participating in the tests, and many of the handsets are being provided for free. Handsets for sale will range from 3,800 yuan to 1,800 yuan, so a lot to watch there. New lows are bringing major Chinese stock indexes back to early 2007. The Shanghai Composite closed April 1st at 3,329, down over 4%, and back to its position of a year ago, although there was a brief rise last Friday on a buying opportunity when some shares in Shanghai saw double-digit increases. The CSI 300 index, last year's darling, is this year's dog. One of the worst index performers of 2008 so far, closed down another 5.5% April 1 to 3,582.86. Shanghai B shares remain battered, lost almost 5% at close Tuesday to 243.49, again back to last April. Shenzhen stocks have fared the worst. All major indexes there down over 7% April 1st. Shenzhen Bs lost another 5% to 536.35, although they have recovered somewhat from the collapse on March 18. The Shenzhen Composite is barely at 1,000 and fell back to last April. Hong Kong shares are a bit better. Both the Hang Seng and China Enterprise Index are recovering. The China Enterprise Index shares of red chips closed April 1st at 12,237, reflecting investor belief that they are a better value than their Shanghai cousins. Despite paper losses in stocks, the Chinese economy continues to race ahead. Industrial profits were up February overall, but the state-owned sector sank almost 30%. All other sectors were up, and the most spectacular profits were of private enterprises that surged 552%. The most profitable industry sectors were oil and gas majors, not surprising given oil prices. All global oil giants currently have massive profits. Coal mining, construction materials, and special machinery, transportation equipment, and electrical components were all up with big profits. The least profitable sectors were steel, chemicals, and smelting, showing overcapacity in those areas. The worst data comes from the electric power companies, whose profits were down over 60% on the winter storms. And chemical or synthetic fiber manufacturers are also way down. Other economic indicators were largely unchanged from January or the end of fourth quarter 2007, except industrial production and some exports are slowing. Chinese consumer confidence was down sharply in Guangzhou, Shanghai, and Beijing, the probable areas of highest stock ownership, although Guangzhou was impacted in many ways by the severe winter storms. But is help on the way? Premier or Prime Minister Wen Jiabao said this weekend Beijing will ensure stability in the markets and that it is important they stay healthy. Some in and out of China interpret his remarks to mean Beijing might resort to bailing out investors if the market implodes, much as Washington is currently paying for the investment mess in New York. Wen made his comments at the third summit of the Greater Mekong Subregion Economic Zone, or the GMS Summit. The GMS was initiated by the Asian Development Bank back in 1992, but suffered a setback in 1997 due to the so-called Asia currency crisis. After a decade, it is back in focus, particularly for Beijing, who wants to recreate the Greater Chinese Economic Area of past empires. Leaders from China, Thailand, Burma, Laos, Cambodia, and Vietnam are all present and pledging further economic integration. One of the big topics is rice. The price of rice on world's markets is up 30%, and stock levels in China are the lowest in years. Nonetheless, Beijing is assuring Chinese there is no supply crisis and continues to allow large exports. The high prices for rice will benefit Thailand, long the biggest rice exporter. The Greater Mekong Subregion is backing infrastructure in the region with highways, dams, and power transmission all in the works, and a big project to build a railway from Singapore to Kunming, the capital of southwestern Chinese province Yunnan, the place working the hardest to build its economy south into Indochina. The GMS Summit is underway now in Vientiane, the capital of Laos. I'll see you next time on the Sinomania Show. That's a wrap.
Delicious.